We had every indication that this would happen for months now, and yesterday the Federal Reserve increased interest rates for the first time in nearly a decade after a unanimous vote from the Federal Open Market Committee. So to review, this is the interest rate at which banks and credit unions trade balances. It is sort of the interbank lending rate, and it's the marker rate for a number of different financial instruments that influence our lives every day, and we'll discuss that a little bit later. The Fed put out a statement saying the decision to increase this base rate was influenced by, number one, significant improvement in the labor market, number two, confidence that inflation would rise over the medium term to its 2% objective, and generally the understanding that hiring would continue to happen and the unemployment rate will continue to decrease. And looking at that data was actually just as interesting. The Federal Reserve also issued some statements with regard to expectations on the unemployment rate, and they expect unemployment to continue falling to 4.7% next year, and economic growth to increase to 2.4%. Very important. The median projected target interest rate for 2016 is 1.375%. Now, to get to that rate, Lewis, by the end of the year, by the end of next year, the year that's about to start, 2016, we would need 4 sequential quarterly increases. So the Fed is basically saying, this is what we're doing now, a small increase, but we're anticipating 4 more consecutive increases to get us to 1.375 by the end of 2016. And that is quite a projection that is being sort of the cards that are being shown at the end of 2015.
A projection of confidence, right?
Yeah.
And Dave, the right is going to say that this had nothing to do with Obama, of course. And,
naturally.
Whatever. But still, it's a good sign.
The economic recovery is doing well in most but not all areas. So, for example, household incomes remain lower than they were a decade ago when adjusted for inflation. That's bad. That connects to the other issue we've talked endlessly about, which is wages, right? Hourly earnings have risen about an average of 2.2% annually over the last 7 years, compared to 3.3% in the 20 years ending in 2008. And as we've also discussed, this has as much or more to do with the changing dynamics of the economy and also the drastic concentration of productivity increases created by workers to executives and the richest of all Americans. So part of the wage issue is not a broader economic issue in terms of strength or weakness. It's very specific that workers are creating more value, but the lion's share of that additional value is going to the richest. So the question I'm now getting in my email is, how will this rate affect me? In the immediate, it won't have a huge effect on most people. Mortgage rates tend to follow the 10-year Treasury rate, which in and of itself is influenced by the federal funds rate. So over the next 15 to 18 months, we are absolutely going to start seeing mortgage rates move. In the short term, they may move a little bit, but over the next 12 to 18 months, we're going to see big increases. If you're thinking of buying a home, you probably don't want to wait more than a year and a half before the rates could potentially be quite high. But that doesn't apply to everyone, Lewis, right? I mean, not everybody is looking to buy a home anytime soon.
No. Homeowners, I mean, who else is it going to affect? It's not really...
Well, credit cards. I mean,
Yeah.
Credit cards is where those variable interest credit cards, some of the most predatory credit cards that are out there, the rates there can be influenced by an increased federal funds rate. And, you know, the good news, although we could argue how good it is that savings account interest rates are going to start trickling up. They're still going to be laughable. I mean, if you look at what
I mean,
savings...
for the majority of Americans, that is not going to mean a thing, unfortunately.
Unfortunately, most Americans don't have much money in savings, don't have much of a reserve. Now, for big businesses or for the very wealthy, all of a sudden, if you can earn a little more money risk-free, if the risk-free rate for your savings account goes up, you have less of an incentive to do other things with the money, like recycling it into the economy. But we're talking about small shifts. You're not going to be bringing home any significant amount of money from this slightly higher interest rate at banks.
Yeah, I mean, the best news really is for the banks and lenders. I mean, that's pretty much it. So, Wall Street, right?
Absolutely. And what Bernie Sanders has immediately said is this is not good for working families. I mean, yeah, okay, it might not have a huge impact, but this is not going to do anything positive for working families. And that is not a completely unquestioned statement, right, that Bernie Sanders is making. But in the short term, this is not going to have a huge impact pragmatically, but the broader sort of psychological impact of the Fed saying things are good enough that after this 10-year period of not raising rates, we are going to raise them. We'll continue to follow it and follow its impacts.